Hey, I'm Dan Fitzpatrick here at StockMarketMentor.com, and I want to look at Qualcomm. Happily, not because I'm long and I'm wondering how far down the stock is going to go, but rather because this is actually kind of representative of a lot of things in the market these days. They, meaning a lot of people, say you don't want to try to catch a falling knife. This pretty much looks like a falling knife to me. It definitely looks like a falling knife to me. You don't want to catch this, right? But here's what you can do. You can really take a good look and see if maybe this is a falling knife that's closer to the butcher block than you think. And the butcher block doesn't have to be your hand. First of all, market didn't like the earnings release. Stock fell, bounced along the 200-day moving average, did not bounce much, and we were all over this thing on Stock Market Mentor. I think I might have been covering this on the free chart stuff. I don't really remember. But I'd mentioned like this is not a strong bounce. This is not good. And so what happens on Thursday? And this isn't an I told you so. I mean, anybody who's reading charts can look at this stuff. This is not cutting edge stuff. It might be for you, but this is not cutting edge stuff. So we get a breakdown below support. Okay, many stops were hit, guaranteed, and I'm going to show you where to place one in a second here. So many stops were hit. Big down day on Thursday, that's day one. Big down day on Friday, that's day two. There's such a thing as the rule of thumb. I didn't invent it. You can read a book by Buzzy Schwartz. And I think that's Pitbull, but I'm not sure. I don't remember. I've read so many books. But he talks about a 3-day rule, but I've modified it to a 3-day rule of thumb just because of the nature of what I do. Members are always, and it's totally understandable, are always looking for tried and true rules so that they can automate their trading. Unfortunately, it doesn't work that way. But the idea is the real smart money sells on the first day. That's the big money. The semi-smart money, who they kind of figure out what's going on, they sell on the second day. Finally, on the third day, the only folks that are left to sell are the ones that have been holding this thing way down, and then they finally freak out and they wind up selling right at the bottom and the stock bounces. So that's what I'm kind of looking for in Qualcomm. But just to look at this chart would not be enough to get me in. That's just not my deal. But if we go down to like a 5-minute chart and forget about the moving averages, they're not relevant. I'm just too lazy to change them. You look here, and this is what I'm looking at. Stock was drifting all the way down until 105. One last gasp at 1 o'clock. 105, this is when the volume maxed out on the downside. Okay? And then what happens? The stock trades up. First bar on big volume. And then it gets drifty through the rest of the afternoon. Big market on sell, buy on close orders here. Lots of buying right at the close. Okay, my bet is that this is the bottom, 71.82. I think you can buy this stock. You keep a stop just a little bit below 71.82. Let's call it 71.75. How's that for defining your risk? You keep your stop here, and then what you're doing is you're buying a stock that's absolutely gotten crushed, that's gone down over 11%, lost 11% of its market cap on one nasty earnings number. It's still Qualcomm, guys. So you're able to buy this stock. Who knows how far up it's going to go, but you've got a defined risk right underneath Friday's intraday low. That's where you buy this stock. Okay, members, I've got actually a lot of material for you to look at. Happily, you can use the fast version, so you don't have to listen to me yammer on at this speed. But there's a lot of material in there for you to cover, and it's about how to get your trading game where it needs to be and thrive in this environment. It's not just buy this, sell this, buy this, sell this, okay? All right, I'll see you over there.